Hi, this is Lara at Elliott Wave Stock Market with your daily analysis for Tuesday 10th of June, recording the video 4:40 p.m. Eastern Standard Time. As expected, the S&P moved lower, but it's really not very much, and it's certainly not enough to give us any confidence in a trend change. I want to see that small channel on the hourly chart very clearly breached before I have any confidence whatsoever that we have a high in place. I want to see thereafter movement below 1918.60 and I will have a reasonable amount of confidence in a trend change. And finally, movement below 1868.17 will provide full and final confidence that the S&P is in at least an intermediate degree correction, which should last at least 2 weeks and probably more likely about 5 weeks in duration. Let's have a look at the charts. The bullish wave count expects a bull market began a few years ago at 666.79. Within that bull market, we have primary waves 1 and 2 complete, and we're within a primary degree third wave. Within primary wave 3, intermediate wave 1 ends here as a very long, extended 5-wave impulse, and the final 5th wave within it is an ending contracting diagonal. I don't want to put the label of the third wave anywhere else than here, because here the subdivisions fit absolutely perfectly, and minor wave 3 is less than 1 point off 2.618 the length of minor wave 1, and with minor wave 3 lasting close to 2 years, that's an exceptionally, remarkably close Fibonacci ratio. This all fits with momentum as well. The third wave within intermediate wave 1, its middle, has the strongest upwards momentum. Here we have a 4th wave correction and an ending contracting diagonal for the final 5th wave. Intermediate wave 2 should last at least 2 weeks, probably more likely about 5 weeks, and it should look like this, or this, or this, or probably a little bit bigger than these, and it should find support at the lower of the double aqua blue trend lines. These two trend lines are drawn using a traditional technical analysis approach. This lower one began in October 2011. It's reasonably shallow, repeatedly tested, and so it has really strong significance. I would not expect intermediate wave 2 to breach this trend line by any more than 3% of market value. The lower edge of the huge maroon channel, here's the upper edge, is copied over from the monthly chart. This is a base channel drawn around primary waves 1 and 2. Primary wave 1 began back at 666.79, the end of the credit crunch. Second wave correction at intermediate degree should not breach a base channel drawn around a first and second wave at primary degree, or any degree higher than that. So, second intermediate wave 2, if it got down that low, should find very strong support at the lower edge of this base channel and should not breach that trend line. This trend line is the differentiator between the bullish and bearish wave counts. At this stage, I am struggling to see a possibility for minor wave 5 to continue upwards from here. We could move the degree of labelling within it all down 1 degree, and this could be minute wave 1, leading contracting diagonal. We'd still be expecting a second wave correction, but at minute degree. That one probably to find support at the upper aqua blue trend line, but we'd still need a sizable correction lasting at least 1 or 2 weeks. So we still expect at least some downwards movement from here. The only other possible structure for minor wave 5 would be an impulse, and I am struggling to see how an impulse or a series of overlapping first and second waves could fit, because so many of these upwards movements here are 3-wave structures, not 5s. An ending diagonal requires all of the subwaves to subdivide as single zigzags, and so this structure fits for this piece of movement absolutely perfectly. Ending diagonals or leading diagonals are usually terminal structures, and they are usually followed by reasonable corrections, so I'd expect this one to be reasonable. If the final 5th wave were to continue any higher, and it most certainly at this stage could, it might not be about to turn here, if it moves any higher, there is a limit to minute wave 5. Because the diagonal is contracting, the third wave is shorter than the first wave, and because a third wave may never be the shortest, the fifth wave is limited to no longer than equality with the third at 1973.72. Let's look at the hourly chart where the high, which could possibly be in place up here, is this point here, and we will use the hourly chart to provide us with confirmation of this trend change. In the first instance, I expect to see this small channel drawn around minuet wave C clearly breached to the downside. It's drawn using Elliott's second technique. The first trend line is drawn from the low of subminuet wave 2, which is now off to the left of the chart, to the end of the fourth wave here, and a parallel copy placed on the end of the third wave. When this channel is very clearly breached with at least one or two full hourly candlesticks below it and moving strongly lower, then I will have some confidence that we may have a high in place. Price movement below 1918.60 would provide further confidence, that's this point here. At that stage, downwards movement may not be a second wave correction within the final fifth wave, and so this fifth wave would have to be over. Further price movement below 1868.17, that's the beginning of minuet C off to the left of the chart now, could not be a second wave correction within the C wave, and so the C wave would have to be over, and that would give me full and final confidence that we have had at least an intermediate degree trend change up here. Intermediate wave 2 should start off with an A wave, which may subdivide as either a 3 or a 5, but the first part of it should be a 5 wave structure down. When we have a nice clear 5 wave structure on the hourly chart, and preferably on the daily chart as well, I will have very high confidence that we're in an intermediate degree correction to last a few weeks. The bearish wave count is expecting a huge market crash from this point. We have absolutely zero confirmation of this at this extremely early stage. This bearish wave count requires the base channel, which for this one is a corrective channel around cycle wave B, to be clearly breached on the weekly and then monthly charts before I have any confidence in this idea. If we see the lower edge of this base channel very clearly breached on the weekly chart, then I will switch this bearish wave count from an alternate to a main wave count. At that stage, what's currently our main wave count, the bullish wave count, would become an unlikely alternate. But if that happens, it's not going to happen for a few weeks yet. It's still a ways away, and it still is an alternate at this stage. That's all for me today with your S&P analysis, and I hope that all our members are having a fabulous day.